Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Petrobras' stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Petrobras operates in three business areas. The first is exploration and production, the second is refining, transportation, and marketing, and the third is gas and power. It controls significant oil and energy assets all over the world, but Brazil represents a majority of its production. Most of the oil and gas consumed in the country of Brazil comes from Petrobras. The company is headquartered in Rio de Janeiro, Brazil, and was founded in 1953. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, Buenos Aires, Spanish Bolsa, and London Stock Exchange. Let's get started with the model. This is a large cap company, 68 billion market cap. They're trading at $10.43 a share, and they have 6.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look at their free cash flow growth from 1.7 billion way up to 40 billion. That's just unbelievable growth. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's gone from 8 billion up to 37 billion. Revenue is the sales for the company, and that's grown a lot as well. It did drop from 2019 to 2020, but then grew a lot from 54 billion to 125 billion. This is the company's income statement. The top line is the revenue of the sales. Their revenue in 2022 was 125 billion. Let's dig into that number so we know what it represents. Of the 125 billion of revenue, 76 billion was from oil products, 40 billion from diesel, 16 billion from gasoline, 5 billion from liquefied petroleum gas. Jet fuel is pretty big at 5.4 billion. Naphtha, 2.4 billion. They generated 7.7 billion from natural gas, 7.7 billion from oil. So in Brazil, they generate 94 billion of revenue. Outside of Brazil, they generate 30 billion. Of the 30 billion of foreign revenue, 19 billion is from oil, 7.4 billion from fuel oil. Their revenue and profits are highly dependent on the price of oil. When oil prices go up, so does their revenue and profits. Here's a breakdown of their revenue by country. 94 billion in Brazil, 7.2 billion in South America, 6.4 billion in China, 5.9 billion in Europe, 4.9 billion in the United States, 4.3 billion in Singapore, and 1.5 billion in all Asian countries, excluding China and Singapore. Let's go back to their income statement. Below revenue is cost of revenue. These are the expenses directly related to generating the revenue. An example of something in cost of revenue is the cost to buy the petroleum and the fuel. Revenue minus cost of revenue gives you your gross profit. Their gross profit margins are above 50%. The way you calculate gross profit margin, it's gross profit divided by revenue. It's how well you convert revenue into gross profit. And that doubled from 2019. It grew about 50% from 2021. Then you have operating expenses. These are all the expenses not directly related to generating revenue. An example of this is their payroll for their executive team. Gross profit minus operating expenses gives you your operating income, and that tripled from 2019 to 2022. They spent 2.8 billion of interest on their debt, which is a lot lower than prior years. It was up to 6.3 billion in 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. It looks like they had a really big asset impairment in 2020 of 11 billion. That's why their net income was so low. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income. You notice as you get lower in the income statement, the growth is more exaggerated, because on the top of the income statement is revenue. Their revenue growth from 2019 to 2022 was about maybe 60-70%. Their gross profit growth from 2019 to 2022 to 31 billion to 65 billion was a little over 100%, maybe 110%. Operating income growth, the 18 billion to the 55 billion, that was about 200%. And the net income growth, the 8 billion to the 37 billion, was about 400%. So as you go lower on the income statement, the growth gets more exaggerated. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So their cash flow doubled from 2019, from 26 billion to 49 billion. Then your capital expenditures, investments in property, plant, and equipment. They spent a lot on CapEx in 2019, 24 billion. Operating cash flow minus CapEx gives you your free cash flow. And that's grown a ton from 1.7 billion to 40 billion. And they've been paying down lots of debt. They paid down 15 billion in 2022, 27 billion, 32 billion, and 32 billion. They do add debt each year, but not nearly as much as they're paying down. That's why their interest payments on their income statement were so low in 2022 compared to prior years. Let's look at the capital structure. 69 billion of equity, 54 billion of debt. They're 56% equity, 44% debt. And their net debt is 43 billion, so it looks like they have about 10 billion of cash on their balance sheet. I gave them the highest whack on Finbox, 15.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 135 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $159 billion. We divide that by 6.5 billion shares. And we get a calculated stock price of $24. They're trading at $10, so they're trading at a 57% discount. It's a really strong buy according to the model. 9 analysts projected their future revenue for 2025, and their target was 500 to 1 billion Brazilian reais. When you convert that to US dollars, that's 100 billion US dollars. Their revenue target for 2024 is 99 billion. 2023, it's 107 billion. I continued this trend into 2026 and I got 102 billion. That's how I got their future revenue estimates. And they convert on average 28% of their revenue into free cash flow, so I multiplied their future revenue estimates by 28%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $20 a share. They're saying it's 47% undervalued. 3 analysts priced this stock and the average price target is $12. The low is $11.50, the high is $13. This is where the stock has been trading the last 5 years. So it was up to about $20 a share before 2020. Then during COVID, it dropped like a rock, like most other stocks, including oil stocks. It was down to $5 at its lowest point. Then it got past $15 again at the end of 2022, but it's dropped a lot since that point, sitting around $10. In the past 5 years, this stock is down 26%. In the past 5 years, Brent Crude and West Texas Intermediate are both up about 16.5%. I guess this stock isn't doing as well as oil because they pay such high dividends. If they didn't pay these dividends, the stock price would do a lot better. They pay some wacky dividends. Look at the amount of dividends they paid the past few quarters. $1.30, $2.59, $1.47. If they continued paying $1.30 dividend, their dividend yield will be 50%. Which is 84% of their free cash flow, 92% of their net income. Here's a chart of their dividend yield since 2012, and the forecast is for their yield to be 12% by 2025, which is still a really good yield. They have a beta close to 1, so the stock moves with the market. It's down 31% in the past 52 weeks, while the S&P is down 10%. The 52-week low is 9, the high is 16. The stock is on a downtrend, trading below its 50-day and 200-day moving average. This is a really popular stock. About 20 million shares are traded each day. Of the 6.5 billion shares outstanding, 4.1 billion are on float, 22% are held by institutions, and 1/2% of the shares are shorted. They've done 2 stock splits, a 2-for-1 in 2007 and another one in 2008. If you invested $10,000 into this company 10 years ago, you'd be in the red most of the time, but if you kept holding on, you'd be at $13,000 today. That's a 3% annual return. 37% of the company is held by institutions, 29% by the Brazilian government, 26% by the general public, 8% by venture capital and private equity firms, and a really small percentage by private companies. They do employ 45,000 people, but that's been going down over the years. They were close to 70,000 people in 2017. That's generally not a good sign when an employee count goes down a lot. Their biggest shareholder is the Brazilian government, which can be a concern for some people. They own 29% of the company. Their second biggest shareholder is the Brazilian Development Bank at 8%. Then GQG Partners, this is a Florida investment firm, 5.5%, BlackRock at 4%, and Vanguard at 3%. The best way to look at ratios to compare them to companies in the same industry, there are 11 companies in the same industry as Petrobras, and if Petrobras has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do spend more than average in CapEx, 10 billion, average is 6.5 billion. They are a bit more leveraged than the average company, but they are paying down lots of debt year after year, so they're trying to get that number more in line. They pay a crazy high dividend. They generate lots of free cash flow, more than BP and Total Energies, and a little less than Chevron. But the reason their market cap is so much smaller than the other companies is because Petrobras is Brazilian, and there's a country risk that's associated with Brazilian companies and certain countries. BP is British, and that's not a risky country. Total Energies is also British, and Chevron and Exxon are American. They have amazing ratios, really, really good. Once again, because they're a Brazilian company and the market cap should be a lot higher, but it's not. That's why their ratios look so good. They generate lots of revenue, more than just about anybody on this list, relative to their market cap. But of course, they generate less revenue than these monsters above them. And they have a really good ROA and ROE. ROA is net income over assets. ROE is net income over equity. So to summarize, I have them trading at a 57% discount, and this company is making so much money these days, and the stock should be a lot higher. It's just that country risk. But if you're still willing to invest in them and ignore that country risk, you could have a really nice payday because they pay really nice dividends. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.